Welcome everyone to the Canadian Diabetes Association's Diabetes Awareness Month webinar series. My name is Farah Ismail and I'm a program manager at the CDA and I will be your host this evening. We are delighted that you're able to join us today for a webinar to learn all about tax tips and diabetes. Now to start off, I'd like to draw your attention to the survey which is located at the top right-hand section of your screen. In order to better serve your needs, we kindly ask that you provide us with your input by completing the short survey towards the end of the presentation, and we thank you in advance for your input. Now, throughout the presentation, you will have the opportunity to type in the Q&A box that's located at the bottom right-hand section of your screen, and we ask that you use this box for any questions that you may have for the presenter throughout the presentation, and we'll be sure to get to it at the end of the presentation. As well, throughout the presentation, we will be displaying a few polling questions, and we would love for your participation. It is important to note, however, that the participation remains completely anonymous. Also note that you're able to customize your screens to expand and collapse them as you see fit. So feel free to adjust them by dragging down the bottom right-hand corner of each of the webinar pods. The presentation itself will last about 40 to 45 minutes in length, and we'll have about 10 to 15 minutes at the end for questions. It's important to note that our presentation today is recorded and will be posted on our CDA website. So now I'd like to welcome our speaker, Diana Provenzano, and thank her for joining us today. But before turning it over to Diana, I'd like to give you a brief introduction. Diana Provenzano has held various senior financial positions. She currently provides financial advice to individuals and small businesses, including assisting clients with obtaining their full tax benefits. She is a CDA board member, audit committee chair, and GTA regional chair. Now for more information on Diana, please read the speaker bio section, which is to the left-hand section of your screen. So without further ado, I'd like to present to you Diana Provenzano.
Hello everyone, I'm happy to be with you here this evening. So to begin, first of all, I want to stress that tax legislation changes all the time, and therefore these slides are with tax legislation effective as of November 1st, 2015. If you look at these slides subsequently, do keep in mind that you need to get advice for your own personal circumstances and make sure that the data you're using is current to the tax legislation in effect at that time. I will this evening be talking about just some general tax tips. Medical expenses for people with diabetes, of course, are significant, and so a general discussion on medical expenses. I will also discuss the disability tax credit with emphasis for people living with type 1, and if you qualify for the disability tax credit, how you can apply for the disability savings plan. So let's start. So first of all, I know that most people are not going to be pleased to hear me tell you that you need to start right at the beginning of the year to set up a folder to collect all your tax receipts. So you're a little behind time right now, or you could say you're early for next year, for 2016. So collect all your tax receipts. That means, your donations, your medical receipts, your transit passes, your child care expenses, children fitness receipts, investment activities, just to name a few things. In addition, I suggest that you register for My Account on the Canada Revenue Agency site. Registering for My Account permits you then to have access to your past tax returns, also lets you know when a refund is coming if you're entitled to a tax refund, but also gives you the information about how much you have available to make a contribution to your registered retirement savings plan, or if you have to repay your home buyer's plan. Now, this process takes about 6 weeks, because once you register onto the site, they then need to mail you a code so that you can proceed to the next step. So about 6 weeks' time, but well worth the effort in doing that so that you can look up your personal information for tax. Let's now commence with filing your tax return. So annually, in mid-February, the Canada Revenue site or updates a webinar on how to complete your tax return. I suggest everyone who is a first-time filer to go through the process, even if you are using professional to do your tax return. It is well worth the effort to go through the webinar. It may give you some idea of some questions that you want to ask your tax preparer. CRA also in mid-February, around the 20th or thereabouts, will upload several pieces of free tax software so that you can actually use the software to complete your tax return. The software is very similar to what you purchase at a local Staples store or Costco, but here you're getting it for free. Now there are some restrictions with the use of the software based on income, but generally speaking, about 60% of the people can use the free software. Of course, a common question I get is CRA, if I use their software, am I more likely to be audited? And the answer definitely to this is no. Likewise, people who continue to use their tax return and do their tax return by pen and paper are no more likely to be audited or not audited. So, I would suggest using the free software if you qualify, or go to getting your return done by yourself if you wish. So let's see how we actually calculate the federal taxes payable. First of all, it's your total income. So you need to sum all the different types of income you may receive: your employment income, your pension income, investment income, or financial assistance income that you receive. That is your total income. Once you arrive at your total income, you then are allowed to deduct certain deductions. And I'm going to speak about some of these deductions in the future slides. So total income less deductions arrive at net income. Now net income is a very important number in your tax return, because this is the number that determines how much medical expenses you're going to be able to claim. It also determines if you qualify for the GST credit and for various provincial social assistance tax programs. Of course, to arrive at taxable income, you need net income less other deductions. I'm not going to be spending a lot of time on this less other deduction factor, but generally it is capital gains and losses, or if you receive financial assistance income, it'll be less any financial assistance income that you receive to arrive at taxable income. Then it is taxable income times the applicable tax rate for your province and federally to arrive at taxes payable. So let's look at some of the deductions that we can claim. For individuals, and this applies to anyone that is employed, they should maximize their contribution to the registered retirement savings plan. This is especially true for anyone that is in the higher tax brackets. Generally speaking, someone who is earning greater than $75,000. That number, of course, varies by province, so this is a generalization. $75,000, let's say, if you earn that, you want to contribute to your registered retirement savings plan to reduce and bring your income possibly to a lower tax bracket and therefore result in a lower paying amount. A common error I see that most people do not deduct professional membership dues. So your professional fees are a deductible expense. Another area that you may be looking at is if you need your vehicle, for example, for travel, not to and from your office, but let's say you do other business travel to go visit clients or to go sales accounts. Then if you use your vehicle, you want to track the cost of running your vehicle and how much you use it for business purposes compared to what your employer is reimbursing you. If your expenses are greater than your reimbursement from your employer, you may want to consider claiming employment expenses. And certainly not a deduction, but a credit that's available to all individuals is charitable donation credits. But if you're a first-time donor, have not donated in the past 5 years, you can actually claim an additional 25% on your credit. So if you make a $100 donation, it would cost you now about $60. Okay. So some tax tips now for families. Again, consider a registered retirement savings plan. Now, in this case, I've said consider a spousal registered retirement savings plan. If the couple has different income, a higher income and a lower income person, then you may want to set up a spousal registered retirement savings plan in preparation for when you retire, the income is then split more evenly between the couple. The other option is that if that individual one of them wanted to take some time off later on in life to take a break from employment, they can actually then take the money from the registered retirement savings plan to help with any income shortfall. The other option is, of course, if you have a registered retirement savings plan, to use it to borrow for your purchase of your home. So for a first-time purchase of a home, you can borrow up to $25,000 from your registered retirement savings plan. Likewise, you can borrow from your registered retirement savings plan for a lifelong learning plan of up to $20,000. Now, of course, whatever you borrow from your registered retirement savings plan must be repaid. For a home buyer's plan, must be repaid over 15 years, and for the lifelong learning plan, over 10 years after you've completed your course of study. You also, if you're a first-time home buyer, have not purchased a home in 5 years, both for yourself and your partner, if you're a couple, then you can apply for a home buyer's incentive. This is a non-refundable incentive of $750, so you have to have taxes payable to get the benefit of this incentive. And I recommend that all families who have children to consider applying for the Registered Education Savings Plan. So establishing a Registered Education Savings Plan with your financial institution, and by making some contributions to those plans, the federal government matches those contributions to certain limits on an annual basis. Now, there are some provinces that also have Registered Education Savings Plan programs with grants, and you need to apply to those provincial programs separately than the federal programs. Child care expenses. A common misunderstanding is that there are certain things for child care expenses that are usually not included by people, but you should consider including camp fees, daycare center fees, sports school costs, provided they're not for regular educational programs. All of these can qualify for child care expenses. And then when claiming children's fitness, arts, and credits, remember that the program is not only a federal program, but you also want to claim the applicable amounts in the respective provinces that have children, fitness, art, and credits. Few tax tips for students. So most students, I know, do not want to file a tax return. But in actual fact, it's very important for students to file a tax return. Not only because by filing a tax return, if they're low income, may qualify for a GST credit, but also because they may have qualified for provincial assistance programs as a result of filing their tax return. Remember that net income figure is very important for qualification in various programs. As a student is fully in full-time education, any scholarship income they receive is not subject to tax. But you need to file so that Revenue Canada knows that it's because you are actually in full-time education. Tuition. It's very, very important for students, again, to file their tax return to report any tuition costs that they've incurred. Now, these are not deductions, but these are credits that you receive. And when you report your tuition, you also want to claim the corresponding education and textbook amount. You may not need the tuition credit. You may transfer the tuition credit of up to $5,000 federally to a parent or to a grandparent, or you may carry it forward indefinitely until you require it. So it is possible that you go to school for several years, not claim any of your tuition, and then the first year when you actually start employment, you may have accumulated $20,000, $30,000, or $40,000 of tuition credits that you can then apply to your first year of employment and hopefully reduce your tax bill in your first year of employment. In addition, not only for students but adults who continue with continuing education courses and exam fees, those are allowed as tuition credits. You do not get the education and textbook credit, but you can get the tuition credit for any course and exam fees that you pay as continuing student. Provided, of course, your employer has not reimbursed you for those course and exam fees, then they're deductible on your return. Interest paid on student loans are deductible for 5 years after a student completes school. And public transit passes can be claimed not only by the student but also by the parent. And remember that public transit passes are not only the monthly passes, but in some areas you have weekly passes that also qualify. And for students who make donations, you can accumulate those donation receipts, and not only students but individuals, families, for 5 years before you actually claim them. And anyone who actually federally has income individually below $18,000 or as a family unit below $27,740 can apply for the working income tax benefit, and by so doing eliminate their federal tax payable. Now you may still be subject to provincial tax, but it eliminates your federal tax. So let's look at some tips now for our seniors. So first thing is that your registered retirement savings plan should be converted to a registered retirement income fund. And it must be converted by no later than the year you turn 71. Why to do this? Well, first of all, withdrawals from your registered retirement savings plan do not qualify as pension income, whereas funds taken from a registered retirement income fund do qualify for the pension calculation. So converting it, and you don't need to wait until age 71, you can convert it even earlier if you so desire, your RRSP into your registered retirement income fund. Remember that payments from both Canada Pension Plan and Old Age Security do not qualify for the $2,000 pension credit or for pension split income purposes. And therefore, if you are in receipt of the Canada Pension Plan and your spouse is also in receipt of Canada Pension Plan funds, but you're receiving different funds because of your employment over the years of work, you may want to actually write to CPP Canada and request that the funds be accumulated and then split evenly. This way, you're both in the same tax bracket for CPP receipts. And always remember that you can split all your pension income between you and your spouse, which is very important because you want to make sure that you both utilize the full $2,000 pension credit that's entitled to you. Okay. So to wrap up then, it's very important to file your tax return, preferably before April 30th. But if you're carrying on a business, then you have until June 15th to file your tax return. And now there's legislation in place that if you do not file your returns by the end of June, actually they look at, that possibly Revenue Canada can then not have you receive any of your future payments for Canada Pension Plan, Old Age Security, and certain child tax benefits after August of that year. So April 2015, you forget to file, you have until June to file before you're affected by any payments that you receive for Canada Pension Plan, Old Age Security, and child tax benefits. But should you not file and comes September, you're not receiving a payment, reminder, go back and file, and then the payments will recommence again. So let's do a little polling question now. Where can you go to file your taxes for free? I'll give you a couple of minutes, seconds I should say, to answer that quick question. Oh, yes, free is CRA software. Of course, you do it by yourself, and there are sponsored tax clinics also that you can use. So all of the above actually is one way of doing your tax returns for free. Let's get on to medical expenses now. Firstly, medical expense deduction is non-refundable. What this means is that if you do not have taxes to be paid, or you don't have a tax refund coming to you because you've made payments through employment, okay, then there is no refund of the medical expenses you incurred. So it's important, first of all, to look at the entire family unit when you're looking at medical expenses. One person should claim all the medical expenses on the return. So that's for mother, father, the spouses, the common law partners, and the children under the age of 17. If you have children over 17, you may want to claim their medical expenses on your return, but then it'll depend on what their income level, and you may also be claiming the medical expenses if you're caring for a parent on your return. So we generally say that the person with the lowest income should report the medical expenses, but that's provided that they have taxable income. How is the medical expense calculated? So if we have an example here where your total medical expenses were $2,800 for the year, and your net income, let's say, is $40,000 times 3%, because the first 3% is not allowed. So 40,000 times 3% is 1,200. So 2,800 minus 1,200 would provide you a medical expense claim of $1,600. Now, at a certain point in time, when you hit approximately $72,000 of income, it's no longer the 3% of times net income. The maximum is $2,171. The $1,600 in this example that I've given here would actually result in you reducing your tax payment by approximately $3,060. So you're getting back $360 of your medical expenses that you incurred of the $2,800 in this example, approximately, depending on the province you're in. So let's look at how we actually determine which medical expenses to include. So it's very important, as I said at the very beginning, to keep that file, because you want to keep the medical expenses for the last 24 months with you at all times. Now, most people feel that they have to claim the medical expenses on a calendar basis, January to December, but that's not required. You can actually claim your medical expenses for any 12-month period, provided that 1 month is in the current year that you're filing your tax return. So in the example I've given here for the 2015 tax return, you can actually pick March 2014 to February 2015. And then the following year, if you so choose, you don't have to start again at March 2015 and go to February 2016. You can say, well, I'm going to pick from June 2015 and go to May 2016 as an example. The months do not need to be consecutive, but what is most important is that you do not repeat a similar month. So you can't choose February 2015 in 2 different tax years. You want to pick the 12 months that has the highest medical expenses for you and your family unit. So what type of medical expenses qualify? Let's go through those. Premiums paid to an employer medical health plan. So often employers now are charging for your medical, dental, and vision care health plans. So the entire premium that you pay for this is a medical expense. Common place to find this information, 2 places. One, if you have a T4 slip, some employers are recording it as code 85 in the notes. So if you look at your T4, once you get that in February, see if they recorded code 85, then that's your total medical premium that you've paid for health plans. The other option is looking at your pay stub, and I remind everyone to keep the last pay stub of the year because your employer there needs to indicate the total year what you've spent on various things that you get deducted for. So your cost for medical, vision, and dental will be one figure. You'll also have a cost for life insurance and long-term disability plans. The cost for life insurance and long-term disability plans do not qualify as medical expenses. So don't pick up those figures, but the other ones you should. Okay. And if you incur travel medical insurance, that is also a medical expense, but make sure that you keep it separate from travel cancellation insurance. Then, prescription costs that you incur for diabetes medications, insulin, needles, and syringes, for blood strips, for test strips, for pump infusion sets, and peripherals related to your pump, all of those qualify as medical expenses. Now, if you have a program at work where your medical insurance covers you, let's say, an example, you've gone to the dentist and the dentist covers you costs you $100, but your insurance only costs you $80. Well, that difference, the 100 minus the 80, which is $20 in this case, would be considered a medical expense. Likewise, in the pump programs, there are various pump programs in all the provinces for consumables. Let's say you spend $900 for pump supplies, but the program in your particular province only covers you for $600. Then that difference of $300 is considered a medical expense. For people that have celiac disease, the incremental additional cost to acquire gluten-free products would also be considered a medical expense. Travel costs to and from when the distance exceeds 40 kilometers one way. As an example, a person who lives in Thunder Bay needs to travel to Sudbury for a medical appointment. Then the fuel and overnight stay costs for the person and their companion would qualify as a medical expense. Again, provided the distance exceeds the 40 kilometers one way. Okay. And in 2014, we've got a new cost, which is the cost if you have to have a dog for some individuals to detect hypoglycemia, then that cost is also a medical expense. And this is certainly not the only, these are not only medical expenses. There are several other medical expenses. We just highlight a few here. But if you also visit a private clinic for a consult with a medical practitioner, that cost is also considered a medical expense. So who are medical practitioners? The definition for medical practitioner varies by province, since health is governed provincially. You may think of only your dentist or your medical doctor as qualifying medical practitioners, but in actual fact, as you can see from the list that I've provided here, you can have an acupuncturist, a traditional Chinese medicine practitioner, a social worker, a dietitian, a midwife, a radiologist. All of these, if you incurred any fees with any of these people for services provided by them, then those fees are then qualifying medical expenses. But it varies by province, and so it's very important to go to the provincial definition as indicated here so that you can determine which of these people qualify in your particular province. So let's do another polling question. Can medical expenses you claim differ by province? True or false? Everyone's got that right. That's right. It definitely does differ. Just want to look at some other programs. So up to this point, I've looked at the federal program under income tax purposes, but there are financial assistance programs that are available for people that do not have income or have low income and therefore not enough income to claim any medical expenses. In that case, you want to look at the various financial assistance programs that are offered, And there are programs listed on the CDA website. It's listed on my resource what the link is to get to those programs. But generally, they do vary by province, and the deductibles and co-payments may vary, and the eligibility criteria also varies by province. So it's important to go to the provincial information on the CDA website to get the details. The other program that most people are familiar with is insulin pumps, and the CDA has provided advocacy work in this area extensively to expand the responsibility of who can actually get pumps. So generally speaking, every province allows for pumps for people under the age of 19, few provinces under 26, and 2 provinces, Alberta and Ontario, pumps are available for all ages. Remember, pump supplies vary by province, and so when you're looking at your pump supplies and what you qualify, go to the CDA website to get the details of what your provincial program offers. Oops, okay. The next area we're going to go talk about is disability tax credit. So before we start on to the disability tax credit, I'm going to ask you all, if I'm a student with type 1 and no income, should I apply for the disability tax credit? Any idea on that question? It should be yes or no. Let's see. Somehow the poll, we skipped it. We have a yes in the majority of the people. So let's see, does it qualify or not? So, reason that you may want to qualify for the disability tax credit, if you are disabled, the government provides a program where it will help you to reduce your taxable income, knowing that you're incurring excessive costs to manage your particular situation. Generally speaking, the disability tax credit will result in a tax payment reduction of your taxes payable by approximately $2,000. And I said this varies by province, but approximately that. And it also provides you, if you qualify for the disability tax credit, for the disability savings plan, which I'll mention in a few minutes. So who qualifies for disability tax credit? The definition that our medical practitioners are most familiar with and well versed in is when a person has a prolonged physical or mental impairment that will last more than 12 months and restricts their abilities by at least 90%. So if there's a restriction that is greater than 90%, then you may qualify for the disability tax credit. An example of a restriction of this nature would be if someone is blind, for example. But in 2004, new legislation came in place, and at that time, individuals living with type 1, the disability tax credit was broadened to include if you have a life-sustaining therapy requirement. So a person who has a life-sustaining therapy may be eligible for the disability tax credit. The therapy is required to support a vital organ, and of course, for people with diabetes, the vital organ is the pancreas. And this therapy must meet at least 3 times a week for an average of at least 14 hours per week. Now, of course, everyone knows that with diabetes type 1, it's a 24/7 matter. It's not just 14 hours. The thing is that the definition that CRA has put to this life-sustaining therapy is very narrow. And if we look at the definition in detail now on the next page, you'll find that the only thing that they're allowing in the 14 hours per week is for the administration of insulin and for the adjustment of insulin dosage. So everything else that you do to take care of yourself for your diabetes is currently not included by CRA. So you need to demonstrate to your doctor that you're spending at least 14 hours per week on the administration of insulin or the adjustment of insulin. Now, I said per week. These are 7 days. You do not have to take 7 consecutive days. So when you're actually accumulating information to determine if you meet the 14-hour time period, you should consider days such as sick days, high days, and low days. What I mean by high and low, of course, high and low blood sugar days, to come up with your total number of hours that you actually spend on the administration and adjustment of insulin dosage. Seem to be having some problems with the slide forward tonight. The examples of some activities that qualify for the inclusion in the 14 hours during the 7-day period that you select are listed below here. I want to emphasize here is that it's not only for people on insulin pumps, but people on multi-daily injection. So I've indicated here, for example, evaluating and monitoring your blood glucose to assess if it's feasible for you to drive or for physical activity would be an incident that you would record. Responding to a pump alarm, test rechecking for low note pattern, assess how to avoid reoccurrence. Changing a pen cartridge, needle, drawing insulin, and delivery of insulin all qualify as activities under the 14 hours. So you need to accumulate the information to determine if you've qualified. So how to be successful in getting your disability tax credit? Best thing is you are responsible for your process for the disability tax credit, and so you need to manage the process. You should talk to your doctor and first find out if your doctor understands what the definition is for the disability tax credit for someone living with type 1. Remember, they're of the thought process that you need to be markedly reduced in your activity by 90%. And generally people with diabetes, it's not greater than 90% reduction in services. So it's important to go through the definition with your doctor and then have them complete the disability tax credit form. Ask them to return the form to you so that you can then take a copy of it and mail it to your tax center. Because if it doesn't get mailed to your tax center, it's not going to get reviewed quickly by CRA. But before you even get it into the mail, you want to see if your doctor has completed that Section 7 on continuing therapy to make sure that he has, or she has completed it correctly. Once it's mailed and it's in the post to CRA, they will usually send a letter within about 6 weeks' time saying to you that it's under review. A lot of people at this time think that this means it's a no reply, but that is not the case. At that point in time, they're writing to the doctor to reconfirm that you're meeting the 14-hour criteria. So it's important for you to contact your doctor, let your doctor know that they're going to be getting this request, and to also remind your doctor not to send any of your medical records, but to send a letter indicating why you qualified for the 14-hour period and how you qualified, doing only those activities that are permitted by CRA. So now we have a disability tax credit. So now that we have a disability tax credit, let's consider applying for the Registered Disability Savings Plan. So why would I want to register for another registered disability savings plan? I already maybe have a registered retirement savings plan. Well, the reason that you want to register for the Registered Disability Savings Plan is that, first of all, it allows you to set aside an additional $200,000 so that it's not subject to tax while it's in the Registered Disability Savings Plan. But more importantly, it's because of the government bonds and grants that you may be entitled to. The government bonds and grants can accumulate over your lifetime of up to $90,000 that can be provided to you. Now that's all based on when you establish it and what your income is. So let's look at how you qualify for those. I do want to state that any contributions that you're making to the Registered Disability Savings Plan are not deductible for tax purposes. So they're not like an RDSP. It's similar more to a TFSA. When you make the contribution, there's no tax deduction for making that contribution. And payments begin at the age of 60. So, for a bond. So once you've established the plan, and you have the plan, you have to annually apply for both bonds and grants as applicable to your circumstances. So let's say that in my first year that I've set up the disability savings plan, my income is less than $25,584. Then without making a contribution, I will receive $1,000. Of course, you can make a contribution, and if you make a contribution, then you want to apply for a grant, which I'll get onto in a moment. If you actually earn anywhere between $25,584 and $44,000 approximately, then you will receive part of the $1,000 from CRA. You can, in cumulative over 20 years, not consecutive, but at any time, while your income is below those thresholds indicated, earn up to $20,000 over your lifetime from the CRA. The disability savings plan grants have different thresholds. So for every contribution that I make into the disability savings plan, if I make a contribution of $500, I receive $1,500. If I make a contribution of $1,000, I receive $2,000, or a total annually of $3,500 for a contribution of $1,500, provided that my annual income is less than approximately $88,000. The amounts vary, of course, when your income is over $88,000 approximately, that a contribution of $1,000 will receive $1,000. Over your lifetime, you could receive $70,000. That means that you've made contributions of $3,500 for a minimum of 20 years to receive the full lifetime contribution grant of $70,000. All of this has to be done before the age of 49 because you need to hold those bonds and grants for a minimum of 10 years. If they're not held for a minimum of the 10 years, then you may have to repay part of the bonds and grants that you receive once you actually start getting payments out of the registered disability savings plan. So how do you go about establishing the disability savings plan? Well, first of all, you need to select a financial institution that offers it. And when you go into financial institutions, I find that most of them are not familiar with the program, and so you need to let them know you're there to set up because of the disability tax credit. And the beneficiary of the disability tax credit is also the beneficiary of the registered disability savings plan. The holder of the plan can be a parent when you're a child, then transferred over to the individual when they become of age of majority, or it can remain as a joint relationship between parent and child. That's a decision that you as a family unit need to make. Payments start at age 60, and any bonds or grants that you received and have not been held for at least 10 years are subject to partial repayment. It is very important that if you do not continue with your entitlement under the disability tax credit, you then actually, the plan dissolves itself. But you do, let's say by accident, forget to file your disability tax credit, it's come up for renewal, and then you have up to, and I believe it's 3 years, they've just made a change in this part of the legislation to actually file and get your disability tax credit. So the plan doesn't dissolve immediately. Okay. I've provided you with some resources, and I understand that some of the links may not work on all the resources, but if you are having any problems, just contact the webinar, and they will actually be able to make sure that you actually get those resources that you need. And I've also listed here how to complete the disability tax form, where you can get the form from. And this is for people with type 1, the steps that they need to make sure that they complete in the respective sections of the disability tax form. So you're not actually completing other than the first page. The rest of it is all your medical practitioner, which needs to be your doctor or your specialist, your family doctor or your specialist for diabetes care, who actually completes the form for you. And if there are any questions, happy to take your questions at this time.
Thank you so much, Diana, for the presentation today. We've gotten some really great feedback from our participants, and they were very excited with the information that you've provided them, and so we're very grateful for you for providing the information to us. We will have some time for a few questions, so if anyone has any additional questions for Diana, please feel free to use the question and answer box at the bottom right-hand section of your screen. We do have some so far, so I'll start with some of our first questions. One of our participants has asked, how much detail do you need to put on the CRA form for medical receipts? Just the name and place and the amount, or do you need more information? Do we also need to supply them with the receipts?
Okay, well, first of all, it depends how you actually are filing your tax return. If you're doing a paper filing, then you have to submit your receipts with your return. If you're doing e-filing or if you're doing any of the free tax software, you don't actually submit your receipts unless they request them subsequently as a result of review of your tax return. But you do need to keep all your original receipts and all your paperwork to support your tax return for a minimum of 4 years from the date of filing for potential tax audit purposes. So going back to the first part of your question, which was to do with what do you need to know about your medical expense, well, you need to have the date that you incurred the expense. You need to know what it was for and the amount and who you've paid it to. So, for example, if I buy my insulin from Shoppers Drug Mart, I would have the date, Shoppers Drug Mart, insulin, and the dollar amount. And if it's for myself or for my child or for my spouse, you would have to know that also on the form that's required to be completed.
Great. Thank you for that response, Diana. I'll move on to our next question. One of our participants has asked, does the RDSP affect the ODSP eligibility?
The RESP, the Registered Education Savings Plan? Sorry, I'm not clear on that. I didn't.
The RDSP? Does that
the
affect
Registered
the
Disability Savings Plan. So
yeah.
The Registered Disability Savings Plan, does that affect your
ODSP?
No, it doesn't that I'm aware of at this point in time. So these are two different things. So first of all, the RDSP, you need to have a disability tax credit form. So if you have a disability tax credit form, you qualified for the disability tax credit, then you opened up a registered disability savings plan, and assuming your income is below the $25,000 because you're an ODSP, then you would then get the $1,000 basically bond, and as long as you hold that bond in your registered disability savings plan for a minimum of 10 years, then you would not be subject to any repayment on that amount.
Okay, great. Thank you for that clarification. We'll move on to our next question. One of our participants has asked, if a child sets up an RDSP, is the income level based on the parent? It's the family income for any grants and bonds until the child is as long as the child is under 18 years of age. Yes, it's the family income. So that $87,000 that I showed on the screen applies to the family income. Yes. Both for the bond. Oh, the bond is a different value, but for the grant, yes. Okay, great. We'll move on to our next question. One of our participants has asked, with regards to type 2 diabetes for someone who is insulin dependent, can they apply for the disability tax credit?
Oh, that's a very interesting question. I have not seen a claim specifically for someone living with type 2 because at this point in time, the document refers specifically to type 1. That doesn't mean that one shouldn't try. If you can get your doctor to indicate that it takes, sign the DTC form, and you have shown that it clearly takes you more than 14 hours to manage your diabetes, which is in managing insulin administration and insulin injections, then you may, I don't know, you may qualify. It's a matter of determining. You have to submit it, and we'll have to find out.
Great. Thanks for the insight, Diana. One of our next participants has asked, would you say it's common or uncommon for someone with type 1 diabetes to qualify for the disability scheme?
For the disability tax credit for type 1, well, generally speaking, I can only speak with regards to my own practice, that my client base that I introduce it to do qualify, but I can't speak for everyone, if they've gone through the process. That I can't say. You do have to manage the process, so you need to make sure that you follow all the steps, and you do have to make sure that your doctor who's signing the form clearly understands and he or she feels comfortable committing to stating that you are spending the 14 hours just on those two factors that are indicated.
Okay, great. Thanks for that. I'll move on to our next question. One of our participants has asked, can my spouse transfer me money for me to apply to the RDSP?
First of all, anyone can put contributions into the RDSP. That's why there's no annual limit. If you remember, the maximum you can put into an RDSP is $200,000. Let's say all of a sudden you're entitled in 1 year, your grandmother passes away and she leaves you with $20,000. You could put the $20,000 all in 1 year into your registered disability savings plan. You may not choose to do that because it depends. You remember that the $3,500 that you're receiving as a grant is the maximum you can receive in 1 year. So if you want to get $3,500 in more than 1 year, you might want to split that $20,000 and contribute it to your RDSP in several years as opposed to putting it all in 1 year.
Great.
Difficult.
Thanks for that. Sorry, Diana, did you want to continue?
No, I'm saying that some of these areas are very difficult to kind of comprehend just with simple answers.
Yeah, no, that's fair for sure. One of our next participants has asked, does nursery school count as daycare?
Nursery school? Yes. If you provided, okay, so child care expenses, you can claim nursery school for child care expenses, but remember, child care expenses, both individuals, the couple or the family unit, must be employed. Or if you're a single mother, then the one single father, as long as they're employed, then you can claim child care expenses.
Okay, great. And for this next question, I do believe you spoke to this, but I'll ask it anyway for some of the people who joined in a bit late on the webinar. A participant has asked, how much is the amount of the disability tax credit?
Okay. So the disability tax credit, first of all, there are provincial amounts and there are federal amounts. So the actual amount federally, the disability tax credit, what I had quoted earlier in the slide was the tax-affected amount. So the disability tax credit, which I believe right now is about $7,800 federally, it results in approximately, both federal and provincial, to reduce your taxes payable by about $2,000. But it depends on your tax rate and the province you're in.
Okay, great. And we'll just take another question, one or two questions here. Our next participant has said, you had said that the lower income person should claim medical expenses. Does it mean you can combine husband and a wife's medical expenses on one tax return?
Definitely. You always want to combine all your medical expenses onto one tax return. So husband, wife, and all the children. Children under age 17, if they're over age 17, then you have to also look at what their income level to determine if you want to include their medical expenses. And definitely you want to include all the medical expenses on one person's return.
Okay, great. And we'll just take our last question here. Do you have to actually quantify and document the amount of time you spend managing diabetes as part of the application for the disability tax credit, or is it a general statement?
You need to, your doctor, because they're signing the form and they're basically, it's their medical liability insurance that requires them to, when they sign the form, they need to make sure that they're extremely comfortable that you are spending in excess of 14 hours on those tasks that are required by CRA for the definition. So if they're comfortable without you providing documentation, that's really a decision between you and your doctor. Generally speaking, most doctors are asking you to list what you typically do over a 7-day period for the care of your diabetes when it comes to insulin administration and insulin dosage administration. Monitoring.
Okay, great. Okay, great. Thanks so much, Diana. That concludes our webinar for today. Diana, I'd like to sincerely thank you on behalf of the CDA. It's been a really great learning experience for both myself and I know everyone else that's been participating. So we very much do appreciate all the knowledge that you've translated over to us today. I would like to send a thank you out to our sponsor, Lilly, for making this webinar possible. We do have 2 more upcoming webinars before the Christmas holidays, so we do hope that you will participate. We have one next week on building your diabetes team, and the following week we'll end off with some exercise tips for you and your diabetes. So we look forward to your participation in the coming future in our webinars. And for any other questions that you have, please feel free to call us anytime. Our number is 1-800-BANTING, so that's 1-800-226-8464. There is a resource list there at the bottom of the webinar where you're able to download some of the PDFs, some of the resources that Diana had spoken to earlier today. If you have any issues or trouble downloading those resources, feel free to email us directly at webinars@diabetes.ca, and we'll be happy to send you an electronic copy of some of those CRA PDF files. For any other questions that we didn't get to today or any other following questions or follow-up questions that you might have, again, feel free to email us at webinars@diabetes.ca, and we'll be happy to respond. Thanks so much for participating, and we hope you have a great evening.